Hi and welcome back. So in the previous video, we made the conclusion that with regards to equilibrium and profit maximization in the monopolistic structure, we assume that the monopolistic firm aims to maximize profit as well. So in principle, the profit maximizing decision of a monopolistic firm is exactly the same as that of any other firm. And the monopolistic firm must consider its revenue uh, and uh, and cost structures, and will also follow the two basic rules that we defined in chapter 9, i.e., like any other firm, a monopolistic firm should produce where marginal revenue is equals to marginal cost, and this is the profit maximizing rule. So provided that average revenue is greater than minimum average variable cost and in the short run, and or average cost in the long run. That's the shutdown rule. So for the moment, we also assume that the monopolistic firm is subject to the same basic technology and some constraint as any other firm, and that cost structures is not different to that of any other firm. So its revenue structure, however, is different to that of a perfect competitive firm, and we have to examine this more closely before we can determine the profit maximizing position of a monopolist. And this is what we do in this video. So since monopolist is the only supplier of a specific product in the market, the demand curve for the product of a monopolistic firm is the market demand curve of a product of the industry. For example, if TP Cement is the sole supplier of a cement in a particular market, the market demand for cement in that area is also the demand for TP Cement product. So because the market demand curve slopes downwards, the monopolist can sell an additional quantity of output only if it lowers the price of its product. However, the lower price will usually apply to all units of output, which means that the marginal revenue from the sale of an extra unit of output is less than the price at which all units of the product are sold. So the relationship between monopolistic and average revenue and marginal revenue can be illustrated with an aid of a simple numerical example or curve. So the firm's total average and marginal revenue are illustrated in this figure, in these two figures here. So in figure A here, we show average revenue and marginal revenue. So because marginal revenue is the change in total revenue resulting from the sale of an extra unit of output, it applies to the movement from one unit to the next rather than to a specific unit. So the value of a marginal revenue is therefore plotted between the two units concerned rather than against one unit. So our figure A clearly shows that marginal revenue is lower than the average revenue at all levels of output. So this is an important result which always holds when average revenue is downward sloping. So as in our figure A here, if average revenue is a straight line, marginal revenue lies between, or rather, exactly halfway between the average revenue, which is this curve here, and the price axis, which is the vertical axis, this one here. So this marginal revenue curve lies between the two, which is the average revenue and the price axis. So the firm's total revenue is shown in figure B here. So as you can see, the total revenue rises here, and and reaches a maximum and then start falling. So a maximum around there, then it starts falling again. So as you can see, if you compare figure A and B, as long as marginal revenue is positive, total revenue rises. So meaning that between here and there, as long as marginal revenue is positive, you can see that between that point, between 0 and around 4.5, total revenue is rising. And where marginal revenue reaches 0, total revenue reaches its maximum. That's its maximum. That's around the same point where the marginal revenue reaches 0. And when marginal revenue becomes negative, our total revenue starts to fall. So the most important result that are illustrated by these figures is that, one, marginal revenue is always lower than average revenue when the firm's demand curve slopes downwards. Secondly, if average revenue is a straight line, marginal revenue lies halfway between the price axis and the average revenue curve. And these results apply to all cases where the firm's demand curve is downward sloping, including monopolistic competition, and oligopoly. So now that we've examined the revenue structure of profit maximization in a monopolistic firm, we are now ready to look at the short run equilibrium of the monopolistic firm. So this figure here illustrates the short run equilibrium position of the monopolistic firm. So the firm faces a downward sloping demand curve, which is shown by D, which is also the average revenue cost. So this is the curve, the one in blue. So the firm's marginal revenue is lower than the average revenue, and the marginal revenue lies halfway between the average revenue curve and the price axis, as we've indicated here. So it lies between this point and that point. So to maximize profit or minimize loss, the monopolist has to produce where marginal revenue is equal to marginal cost. So in this figure, this is indicated by E there, so point E there, which points to an output of Q1. So at a lower level of output than Q1, the firm's marginal revenue is greater than its marginal cost. So at any point lower than this, the firm's marginal revenue is greater than its marginal cost. So the firm will therefore be able to add to its profit by expanding production. So at quantity 1 or Q1, the additional revenue generated by the last unit of output is equal to the additional cost of producing that unit. So at that quantity, the firm's profit is basically maximized. So if it increases its production beyond Q1, so to this point and above, the cost of each additional unit of output is greater than the additional revenue, and while selling it. So total profit will therefore decline if the firm continues to produce beyond Q1. So like any other firm, a monopolistic maximizes profit by producing that quantity where marginal revenue is equal to marginal cost. So at what price should that output be sold? The answer is quite simple. The monopolist sells its output at the price that consumers are willing to pay for that particular quantity, as indicated by the demand curve. So in our figure here, point M1 is the relevant point of the demand curve. It shows that consumers are willing to pay a price of P1, here, P1 indicated there, for a quantity of Q1. The equilibrium point is therefore P1 and equilibrium quantity is, or rather, the equilibrium price is therefore P1 and the equilibrium quantity is Q1. So the next question to ask is, does the monopolist make a profit in equilibrium? So to determine whether a firm makes an economic profit or a loss, we have to compare total revenue with total cost, or average revenue with average cost. So unlike that, what many people believe, a monopolistic can, like any other firm, make a loss. However, the monopolist that we show in our figure here earns an economic profit. But it's also possible for a monopolistic firm to also make an economic loss or earn a normal profit only. So in our figure here, the monopolistic average profit per unit of output is shown by the difference between average revenue here and average cost, which is this one, shown at Q1. So this suggests that the monopolistic's average profit per unit of output is shown by the difference between this point and this point. That's between M1 and K1. And the firm's total economic profit is shown or indicated by this shaded area here, or can be indicated by the area between P1, M1, K1, and C1. Okay, let's end it here for the second session of our chapter 10 and take it from here in the next video. Thank you.